to the ball game. Take me out with the crowd.
Buy me some peanuts and cracker jack.
I don't care if I never get back. Oh, we'll root for the home team. If they don't win, it's a shame. For it's 1, 2, 3 strikes, you're out at the old ball game.
Yes, a depression. In fact, a worse depression than in the 20s and 30s is already here, at least according to the Federal Reserve. I am going to show you 3 things in this video. One, that the Federal Reserve was already projecting a depression worse than the one 80 years ago. It was making that projection back in March. Very interesting. Number 2, the privately owned Federal Reserve, that's number 2. The Fed is a private institution. I'm going to show you that beyond the shadow of any doubt, despite what people say or what their opinions are. The objective fact of the matter is that the Federal Reserve is a private institution. We're going to go into that very clearly. And number 3, that when the Fed adds assets onto its balance sheet, like it is doing now, taking dodgy assets onto its balance sheet, you, the taxpayer, are on the hook when that asset valuation implodes into nothing. So let's review. In the last 10 to 12 years, astronomical asset valuations by private bankers and Wall Street bankers have fueled hundreds of billions of dollars in bonuses. You got none of that money. That is not your role. Your role in the Federal Reserve System is to absorb losses. You are the chump. You are the sucker. The Federal Reserve is here to facilitate your absorption of those losses. And that's going on right now as the Federal Reserve is adding bad assets onto its balance sheet, where, when the depression hits with full force, you, dear taxpayer, are going to eat the loss, not the Wall Street bankers who are already paid on those assets. They already got their bonuses. That money was cashed a long time ago. That's not your role. But let's start with the Great Depression as projected by the St. Louis Federal Reserve. Here we go. The article is called Back of the Envelope Estimates of Next Quarter's Unemployment Rate. Let's just get right into it. What does the Fed foresee happening? 47.05 million people being laid off during this period. To be clear, that's the second quarter. So by June 30th of 2020, the Federal Reserve is projecting 47 million people to lose their jobs. To give you a sense of how huge that is, the entire labor force, meaning people working or looking for work, is 163 million people. So just shy of a third of the entire labor force is going to lose its job. Nothing to worry about in terms of the unemployment, though. What does that mean in terms of the rate? An unemployment rate of 32.1%. To put that in perspective, the unemployment rate at the peak of the Great Depression was 25%. So the Fed is here telling you casually in a note, hey, we're going to have a depression that's far worse than the Great Depression of the 1920s and 1930s. So there you have the Federal Reserve projecting the worst depression of all time in the second quarter. Now let's look at the Federal Reserve's response to this tragic event. What is the Federal Reserve going to do? We're going to take a brief look at its balance sheet just to see. Here you go. The balance sheet has gone up to $5.811 trillion from $5.245 trillion last week or last episode. And you can see that on the graph here. If you just scroll over, there you go. The peak is just what we said, $5.811 trillion. Well, in any event, you can see that there's a 10 to 11% pop in the Fed's balance sheet just since last episode. Since just a week ago, it's gone up 10 to 11%. We saw a similar graph last week. I want to take a look, though, at another way of looking at the balance sheet that might be more understandable. I think it might be a way that you've never seen before, too. It's more like a box score, where what we can do, this is Table 5 of the H4.1 report by the Fed. It's a weekly report, as I mentioned last time. And the box score is arranged not by rows, but by columns. So the players on the team are listed by column. And you can think of the Fed's balance sheet here as the balance sheet, the total $5.811 trillion, as being a score that is accumulated by the 12 players on the team. And you can see the 12 players here across the top. From the Boston, there's New York, there's Philadelphia. And those 12 are the regional Federal Reserve banks. And each of those regional Federal Reserve banks has its own balance sheet. And you can see the total on each balance sheet on the bottom, across the bottom. So you can see that the Boston Fed, $168 billion balance sheet. The San Francisco is the second biggest Federal Reserve bank. It's got $594 billion balance sheet. So this team is really one slugger, which is New York, with a $3 trillion balance sheet, and 11, inebriated midgets, if I may be so un-PC. But the thing to notice here about the 12 separate balance sheets is look what they add up to. There you go. The 12 players, when you add up their balance sheet, total up to exactly $5.811607 trillion. And that right there tells you that the Fed's balance sheet, when we're talking about its balance sheet, it is nothing except the sum of other balance sheets. Pretty clear, no? Now that we know that the Federal Reserve's balance sheet is simply the sum of 12 different balance sheets belonging to the regional Federal Reserve banks, all we need to know is who owns those Federal Reserve banks, and we'll know who owns the Fed. Pretty straightforward. Now, it's even an easier inquiry than you might think, because we don't have to ask the question 12 times. As it turns out, there's one bank, the slugger, the New York Fed, that speaks to them all. And for the uninitiated, this is going to come perhaps as a surprise, but the Federal Reserve is the New York Fed. When we talk about the Fed, we're talking about the New York Fed. That's what the whole thing is. Let's just cut to the chase. And let's go and see what the New York Fed has to say about the system. And it is going to speak through a coloring book or a comic book that the New York Fed put out in the 70s. This is, this is going to be great, right? And it is called I Bet You Thought. The author is David Freeman. As I said, it's put out by the Federal Reserve Bank of New York. It came out in December of 1977. That is you over there, dear taxpayer. That is you over there on the right. You are the idiot. And what you were going to do in this thing, what the Federal Reserve is going to do in this comic book, is going to list and dispel 14 economic myths through a discussion of money, economic concepts, and the Federal Reserve System, so that bubble over your empty head is going to be filled with information provided by the New York Federal Reserve. Wow, doesn't that sound great, kids? Having your heads filled with all sorts of important banking information? Hey, wait a minute, what are those New York Fed guys laughing at? What's so funny? Well, it's that the 12 regional Federal Reserve banks aren't government institutions, but corporations nominally owned by member commercial banks. That is a good one, because I thought all along that the Fed was a public institution. I thought it was part of the government. Well, I guess not. I guess the regional Federal Reserves are private after all. What do you know? But wait a minute. What about all those commercial banks that own the regional banks? Are they part of the government? Well, let's see. Commercial banks are privately owned businesses trying to earn profits, primarily by lending money to other businesses and to individuals. I guess they're not private either. Let's go on. Don't get the wrong impression from the government-type seals on their windows. Wow, that sounds like some really swell advice. Now that we know that bank seals are misleading, let's see if we can apply our knowledge to another seal. Yeah, I could see what they mean. United States there at the top, Federal Reserve System there, federal, yeah, that sounds like the government. There's a bald eagle on it, a national bird, interesting, and a shield with 13 stripes on it. If I didn't know any better, I would think that was a government seal. Thanks to the New York Fed, though, I now know that's a private seal. That's a seal for a private bank, or a collection of 12 private banks anyway. So now that we know all of this information, courtesy of the New York Fed, let's go back and look at the private Federal Reserve's balance sheet from a week ago. Now, the first thing you'll notice, because I highlighted it, is that those three columns there are averages. I'm not particularly interested in averages. I think of a balance sheet as being a snapshot. So what I am going to do here is to gray out the three columns there and focus on the column labeled Wednesday, March 25th, 2020. And what you see in that column, row by row, is a type of assets. And what we want to do is we want to compare this to what follows the next week, April 2nd, in the balance sheet. And you could sort of see line by line what's going on. Now, I'll cut to the chase and tell you that there are only two assets on the balance sheet here that go up by a huge amount, 70%. The rest of the assets go up 25% or less. Don't get me wrong, 25% or less, that's a big increase in a week. But the two that go up 60 to 70% are the ones that we want to look at. So let's do that. The first is the money market mutual fund liquidity facility. It goes from $30.6 billion to $52.7 billion. That's a huge increase. And then the other one is the central bank liquidity swaps. That goes from $206 billion to $349 billion. Again, another huge increase. Now, what's interesting about this pair of assets is that they are not new. They are not making their debut here. These debutantes, actually by this point, they're not debutantes, they're worn out hookers. They came around in the 2008 crisis, and they have been retooled and revived here. And so what we want to know is, now that they are increasing and that these so-called assets are being put onto the Federal Reserve's balance sheet, who bears the risk of these assets going bad? That's really what we want to know. And so what we want to do is we want to go back to the 2008-2009 crisis and look at what happened and what was the chatter back then when these assets came onto the Federal Reserve balance sheet for the first time. You'll remember from last episode that up until the crisis, really the only assets on the Federal Reserve balance sheets were U.S. Treasuries. They were government issued. And then in 2008-2009, the Fed began embarking on quantitative easing program, where it took a bunch of assets not issued from the Treasury onto its balance sheet. And so let's look at a memo that was written back in that time. And this is from April 20th of 2009. And the first thing you need to notice is this is a memo to the Federal Open Market Committee. That's the FOMC. The FOMC is the policy setting committee of the Federal Reserve. In case you don't know, the Federal Reserve Open Market Committee meetings are held 8 times a year, and it's where very important decisions are made. They're very well attended and very well watched. The minutes for those meetings come out contemporaneously. What does not come out until 5 years after the meetings is the transcript of the meeting and the exhibits and the documentation that are provided to the attendees of the meeting prior to the meeting. And we're looking at one of those things right now. This is a memo from the Board of Governors from two researchers in the Division of Research and Statistics, Eileen and Jay, two researchers, and they're writing a memo to the FOMC. And what they want to discuss here is, you can see this right in the memo, is what path of asset purchases would minimize a policymaker loss function. That's sort of a nerdy, quantity way of saying, hey, we're taking on these assets. Let's talk about the best path of buying these assets. And so there's a little hesitation on the part of the researchers to come right out and say what they think. In fact, there seems to be quite a bit of disbelief on the part of the researchers that the Fed is taking these toxic assets onto its balance sheet. And you can see that here on the second page when they write, costs that we assume that the committee will consider are those related to the volume of assets being brought onto the Federal Reserve's balance sheet. In other words, you do know, don't you, that this is just complete trash that you're putting on your balance sheet. That's what they're saying there when you read between the lines. But the interesting thing and the definitive tell of this comes next, and it is here. Holding a large portfolio of long-term securities exposes the Federal Reserve and thus taxpayers to appreciable capital losses if interest rates rise quickly. Now, the mechanism there is not really important. What is important is the exposure of taxpayers to the risk. In other words, the particular mechanism here is that the Fed is buying mortgage-backed securities. So let's say you've got a bunch of mortgages at a 4% interest rate, and they're all packaged up and bundled up for investors, and then all of a sudden interest rates rise to something crazy like 10%. How much do you think that the mortgage-backed security is going to be worth once that happens? And the answer is not very much, because the asset is now worth a lot less. It's only paying out 4%, and interest rates are now up at 10%. So the mortgage-backed security, if that happens, is not going to be worth very much money at all. And that's what the researchers are pointing out here. They're saying, listen, you can lose your ass here. But they're saying the person exposed to the loss here is the taxpayers. And that's the bottom line, and that's true for all the assets on the Federal Reserve's balance sheet. So all these things, the money market mutual fund liquidity facility, the central bank liquidity swaps, which is a way to bail out foreign banks like Deutsche Bank, Rabobank, Dexia, those banks, Credit Suisse, when those goes down, the central bank liquidity swaps are there so that U.S. taxpayers can absorb the losses of those banks. Isn't that nice? So that's what's going on. When assets come on to the Federal Reserve balance sheet, it's not the private Federal Reserve banks that are going to take the hit here. It's you and me, and that's our system. Well, that's all the time we have for now. I hope you got something out of that. To summarize, the Great Depression is here. It's greater than the Great Depression according to the Fed itself. The privately owned Fed is there to make sure that now that the party is over, you are going to have the hangover. Wall Street's role is to go out and get drunk, and the Fed's role is to make sure that you get swapped in so you have the hangover. That's our monetary system. You are the sucker, you are the chump, you are being harvested by Wall Street. That's the Fed's role, that's the Fed's job. That's the system from the beginning. There's a lot more ways that this is going on. The balance sheet, packing bad assets onto the Federal Reserve's balance sheet, is just one way to do this. There are countless other ways. The looting is just out of control right now. I'm trying to keep up with it as fast as I can, but I'm going to detail other ways this is going on. This has been going on since the inception of the Federal Reserve in 1913. I'm going to get into that too. But I hope you are all doing well. Thanks for watching, and I will see you next episode.